Greetings, I bid to Sir Tony, our beloved lecturer. My name is Donna Dominic, and alongside my groupmate Andrena Prudence Prazelim, Harith Jafar, Rosman Rusli, and also Nur Ain Farhana, we will be presenting the strengths of financial management reform as opposed to traditional financial management. Without further ado, let's get right into it. Financial management reform refers to the process of implementing changes and improvements in the way financial resources are managed within an organization or a country. It involves re-evaluating and transforming financial policies, procedures, systems, and practices to enhance efficiency, effectiveness, transparency, and accountability in financial operations. Financial management reforms typically focuses on several key areas, which is budgeting and planning, financial reporting and accountability, financial system and technology, risk management and internal controls, capacity building and trading, as well as performance measurement and evaluation. Now, let's get into the strength of financial management reform. Firstly is the enhanced efficiency. Financial management reforms often aim to streamline processes, automate tasks, and introduce advanced technologies. This leads to increased efficiency in financial operations, reducing manual errors and enabling faster decision making. It allows organizations to allocate resources more effectively and optimize financial outcomes. Financial management reforms also focuses on enhancing transparency and accountability in financial processes. By implementing robust reporting mechanisms, internal controls, and risk management frameworks, reform help prevent financial mismanagement, fraud, and corruptions. Transparent financial systems also foster trust among stakeholders and improve the organization's reputation. Other than that, reforms in financial management often involve the implementation of performance measurement systems, financial analysis tools, and reporting mechanisms. These enable organizations to gather accurate and timely financial information, which in return facilitates informed decision making. By providing reliable data and insights, financial management reform supports strategic planning, resource allocation, and also performance evaluation. Not to mention, financial management reforms also typically emphasize the establishment of strong internal controls and governance frameworks. This helps mitigate financial risk, ensures compliance with laws and regulations, and also safeguards the organization assets. By strengthening financial controls, reforms contribute to better financial management practices and reduce the likelihood of financial mismanagement. Last but not least, financial management reforms often aim to align financial practices with emerging trends and challenges. This includes adapting to technological advancements, changes in regulatory frameworks, and evolving financial reporting standards. By embracing innovation and flexibility, reforms allow organizations to navigate complex financial landscape more effectively. Next, we will be going into the traditional financial management that will be presented by my teammate, Andrena Prudence Prazelim.
Jennifer Fazlim, and today I'll be presenting on the key aspects and the strength of traditional financial management. The first key aspect is on budgeting and planning. The TFM involves creating annual budget based on historical data and projected financial needs. Secondly, financial reporting and analysis. The TFM includes generating financial statements such as income statements, balance sheets, and cash flow statements based on standard accounting principles. Thirdly, on internal controls and auditing, the TFM emphasizes the implementation of internal control to safeguard assets, prevent fraud, and ensure compliance with financial regulations. Next, traditional financial management focuses on controlling costs and expenses through budgetary constraints. The fifth one is financial decision making. The TFM practices typically involve making decisions based on financial indicators such as return on investment (ROI), net present value, and profitable ratios. Lastly, financial compliance. The traditional financial management places importance on complying with relevant financial regulations, tax laws, and accounting standards. The first strength of TFM is stability and familiarity. TFM practices have been used for a long time, and organizations may have established processes and systems that work well with them. Secondly, implementing TFM practices may be less complex compared to introducing reforms. Since these practices are well established, organizations may find it easier to train staff or even adapting to the existing systems. Thirdly, TFM practices are often deeply ingrained in an organization's culture and operations. By maintaining these practices, organizations may avoid potential disruptions. Next, the TFM practices may be perceived as cost-effective, especially if an organization has limited resources to invest in reforms. Last but not least, in certain industry or sectors, TFM practices may align with industry standards and norms. Adhering to established practices can ensure compatibility with industry peers, facilitate benchmarking, and simplify collaborations.
Hello, my name is Muhammad Harith and I will be presenting on the difference between traditional and modern financial management. So how does modern financial management differ from traditional finance? As critics pointed out that many flaws of traditional financial management, a new and modern approach was put into an action. This modern approach offers a broader outlook on a company's financial planning. Unlike the traditional approach, modern financial management aims to consider both the procurement and effective utilization of funds. It factors in concern about the internal parties and the problem that affects an organization. So, I'm going to tell you the difference or the question that modern financing focuses on. So, number one is investment decision. The selection of assets that business invest in, whether for a long or short period of time, is associated with this decision. Capital budgeting is the process by which financial planners choose and invest in assets, which bear long-time benefits. The modern financial approach also encourages finance managers of firms to deal with assets that have high liquidity. And second is financing decision. The scope of modern financing also allows firms to consider ways to increase the company's cash flow. This is a crucial decision-making process addressing a firm's need for funds as when required. Dividend payout decision is the number 3 factors. So this is the major decision that finance manager must undertake for a firm. Here, the team consider the company's net income to evaluate investors' dividend while simultaneously retaining profit for themselves. This is a pivotal decision to ensure that every shareholder receives fruitful returns from the company. By meeting this need, the firm secures trust with shareholders in the long run. So, the 3 is the one of the factors that are important and that differs the traditional and modern financial management. So that's all for me. I will pass to the next presenter.
The difference between modern and also traditional financial management can be seen in the approach. The modern takes more proactive and strategic approach compared to traditional management. It is focused on future-oriented decision making, a long-term financial planning, and also the performance management. Traditional financial management, on the other hand, often relies on the historical data and follows a more reactive approach. Next is through technology and automation. Modern financial management leverage advanced technologies and automation to streamline financial processes, improving efficiency and enhance the data accuracy. It's emphasized the use of financial management information system (FMIS), data analytics, artificial intelligence (AI), and machine learning for financial analysis and decision making. Traditional financial management may rely more on manual processes and limited technology integration. And the third difference is through the data-driven decision making. Modern financial management emphasizes a data-driven decision-making, utilizing a real-time and accurate financial information. It employs sophisticated financial analysis tools and techniques to derive insights and make informed decisions. Traditional financial management may rely more on intuition, experience, and general industry knowledge.
The first one is the hierarchy structure. In this structure, employees have a little decision-making powers and instead receive instruction from their own supervisor. Due to the hierarchy nature of a traditional organization structure, the individuals at the highest level of management may have a little communication with employees who are not their direct subordinates. For example, information from the upper management may get disseminated through the news, email, and department heads. Next is the goal-oriented. By adhering to established procedures and norms, traditional management seeks to achieve financial stability, profitability, and growth. It emphasizes stability and long-term planning. Traditional management strategy center on the aims and objectives set by the company's higher-ups. This objective often focus on growing sales of profit with a view to satisfying the shareholders. The goal of quality-focused management, in contrast, is to provide a product or service that meets, if not exceeds, the needs and expectation of the client. The foundation of quality-focused management is the idea that when clients are happy with your product, then the sales will rise. And the third one is approach. Control, boundaries, rules, and regulations, and any new business and working methods are all a part of traditional management. Traditional management may be reluctant to adapt to change and blind to problems in the workplace and with their employees. Unfortunately, workers copy their managers' behavior because they have learned that this is the way to succeed. Traditional management does not prioritize employees' personal growth or cater to their unique demands. To advance their own and their subordinates' goal, traditional managers trade valuables with their employees. traditional manager have sway because it is in their employees' best interest to comply with their wishes.